Hi everyone, welcome to Interesting Investments. We have some big news from Netflix's most recent earnings report. The king of streaming has returned to subscriber growth. And while reading their latest earnings report, I wanted to highlight a few things that I've learned about Netflix and the expectations they have for themselves moving forward. Let's get into it and take a look at how Netflix is doing overall before we dive in deeper. Since it hasn't been too long since my last Netflix video, I'm not going to dive too into the numbers, revenue, or profit right now. But we'll take a look at the overall share price as of right now, hovering around $400. Over the last 5 years, that gives it about a 40% return. And if we zoom in a bit further, from year to date, we're up about 35%. That gives Netflix a market cap of about $175 billion, with a PE ratio of about 32x. So as many of you probably already know, Netflix had their most recent earnings quarter report just over a week ago, which not only increased their subscriber count, but returned into a full heavy-hitting growth force. Compare that to its other recent quarterly reports, which had flat subscriber counts at best and negative at worst. So revenue was up 8% year over year, which isn't quite the double-digit number that most were probably hoping for, but it's still a rather good number, especially in the economic conditions we are currently in. And while not making up all of it, a lot of that revenue growth came from its 8.8 million new subscribers, which overall isn't a huge increase compared to the over 200 million that they already have. Compared to total subscribers, this is about a 3% increase. However, subscribers alone are not the only contributing factor to the revenue increase, because a lot of the new subscribers were for the entry-level ad tier, resulting in Netflix increasing their ad plan members by 70%. And while this product is only about a year old, 70% is definitely a fantastic growth rate, even though it still makes up a small percentage as of now. Netflix's operating income was up 25% to $1.9 billion in the most recent quarter, thanks to a number of factors from subscriber growth, ad revenue, and the lack of spending because of Hollywood strikes. After the Hollywood strikes are over, this is expected to make a dip as Netflix goes back to spending on more content. That being said, Netflix did update their margin forecast to 20%, compared to 18 to 20% before. This means that Netflix expects to be more profitable going forward, and being able to reliably repeat that. And you have to remember that is an achievement in itself. Almost every other streaming company is currently still running at a loss. While they have all been quickly raising prices to stop the bleeding, Netflix is not only profitable, but running a profit of about 20%. And I expect that not to stop climbing, largely because Netflix now has a revenue stream that does not require them to constantly make more content. At least not at the ferocious rate they've been known to do. But I'll get more into that in just a minute. The last major thing they mentioned in the earnings report is that 70% of subscribers are outside of the US now. One of Nelson's most recent studies, that Netflix added to its earnings report, gives a bit of insights on the current streaming wars. And as you can see, streaming makes up just under 40% of all US TV screen time share. And there's primarily 3 key takeaways I want everyone to take from this chart. And keep in mind, it's important to take all this with a bit of a grain of salt, because this is a chart that Netflix handpicked itself to add to its earnings report, so obviously it's going to be more favorable than maybe something else. The data for this report was from US TV screen time. How was it allocated, and who are the biggest players? So out of all TV time, you have 3 major industries or categories. Broadcast, which is essentially live events. Cable, which is pre-made stuff like TV shows and your normal channel things. And then streaming, which runs over the internet and you select what you want to watch at any time. Nothing new or significant here, we're all pretty aware of this situation. And it's important to know that streaming is growing its overall market share over time. Broadcast and cable are decreasing, so streaming is the place where you want to be and to ensure your future. And if you're an advertiser, cable will help you get to older audiences, streaming will help you get to younger audiences, and broadcast will depend on whether that's sports or news. So with streaming already the largest portion and growing, the players within it will matter a lot going forward. And the largest streamer, which is to no surprise to anyone who's watching this video, is YouTube. That being said, we're not going to get into YouTube right now. Our focus is the number 2 spot, Netflix. With an 8% market share, and that's of all TV screen time. That's not 8% of streaming content, that's 8% of this entire pie. So if YouTube and Netflix had their own slices, they would be just a bit smaller than that other category, in pink. And the best part about the number 1 and 2 spot is that Netflix and YouTube aren't necessarily always competing. While they both are streamers, they stream very different content and there's not a whole lot of overlap. Now they are trying to steal as much of your time as possible, so they are competing for your attention. But they're not necessarily direct competitors as Netflix is with Hulu, Disney, and Max. And speaking of Netflix's main competition, Netflix doubles its second place competitor, Prime Video, which is a bundled subscription of a lot of other perks that you get from Amazon. And one of the most surprising things from this is that Hulu absolutely destroys Disney Plus still, in at least hours of watch time consumed. And everyone else is basically fighting for dear life, just barely getting 1%. I am interested on whether YouTube is just YouTube actual videos, or is it YouTube's TV bundle, or is it a combination of both? That would be good to know because YouTube's TV cable bundle is a much more direct competitor to Netflix. The point from this chart, and I think what Netflix was trying to drive home, is that Netflix has people's attention. It has their eyes, and it has their focus. And that's not directly important for shareholders or subscriber growth, but it is critically important for advertisers. And I think that's why they added this chart. They're saying, hey advertisers, out of all US consumer TV screen time, we make up 8% of that pie. And as streaming takes up a larger portion of TV screen time, as cable and broadcast get left behind, and its fellow streaming competition are either getting out of the game, selling their content to someone else, or getting bought up by larger players, creating consolidation and less competition. 8% is likely the start, and we are still in the early days of Netflix gathering market share. And with that little preamble out of the way, that takes us right into Netflix's growth plan, as stated by them. And the first part of that is still obviously their main business and their main focus. Paid sharing, increase subscribers, decrease account sharing. This is Netflix taking their tried and true method of growth, at least until it doesn't work anymore. The second part of growth is the part that everyone pretty much hates the most. This is Netflix's continuous price increases, which are not stopping, just to let you know. They are raising the price of tiers in the US, UK, and France. For the US market specifically, the ad tier is staying the same at $6.99. The basic tier is increasing to $11.99 for existing users, but this will not be an option for new subscribers. Standard is staying the same at $15.49, and the premium tier is increasing to $22.99. So as Netflix has learned that people don't unsubscribe when they raise prices, they're going to keep doing that until it happens. And thanks to the low price of their ad tier, they don't have to worry about people abandoning ship completely, when most will probably just drop down to the next lowest tier. So Netflix moving forward is definitely going to test how much pricing power they have. How much will people actually pay? Now that Netflix isn't reimagining and reshaping industries, they can now find out what the true value of their creation is. And that will come at the detriment to everyone's wallet, unfortunately, but as is the way of capitalism. And Netflix has to keep the greedy shareholders like me happy, so that's what they're gonna do. And the most important part of Netflix's growth potential is obviously in advertisements. Because Netflix will one day face the problem that all subscription companies have. One day they will run out of people who don't have a subscription. And on a day not too long after that, they will find out how much people are willing to pay for the quantity and quality of content they provide. So the moral of the story, why subscriptions are absolutely great, especially subscriptions with pricing power, as Microsoft, Adobe, and so many other companies in the tech industry have pioneered, there are still a finite amount of people in the world, and they are only willing to pay so much. And depending on wealth and income levels, some of them are completely unable to pay at all, and will likely never be able to pay. And that's where advertisements come in. Because while consumers may not be willing to pay more for Netflix subscription, they may be willing to put up with seeing more ads, or paying less and seeing even more ads, and then which Netflix gets paid by the advertiser instead of by you. Either way, Netflix is getting paid. Not only is advertising generally very profitable, but the niche and value proposition that Netflix is going to offer I think is truly an incredible opportunity. Advertising on Google search has become very cutthroat and ruthless. It's very hard to get a leg up on anyone because everyone basically does it. Facebook, Instagram, Twitter, Pinterest, Reddit, and YouTube, to a lesser degree though, all come with the problem of that they don't control the content they make, and it can become a very toxic mess of a place to be. And advertisers generally don't want to be in front of a toxic mess. So Netflix provides scale, they provide safety and security for advertisers, who are, especially in these times, are constantly getting in trouble for being on the wrong platform or in front of the wrong tweet or message or content. And unlike social media, who has to give some portion of advertisement revenue to creators, Netflix owns the vast majority of their content, meaning that legacy content will finally start to make Netflix a lot more money going forward. Because a show from 4 years ago doesn't really contribute to new subscribers. But as new subscribers and watchers trickle in and watch shows that were made years ago, they will now generate ad revenue and therefore profit with pretty much no cost because Netflix probably already paid for the content in full. This could increase exponentially if they allow people to watch old content for free. So imagine shows that are 6, 8, 10 years old, and every subscriber either doesn't care to watch it or has already watched it, and is essentially just costing Netflix data server space, could eventually be put onto a free tier to allow millions of people who could never afford Netflix to finally watch it, and Netflix could gather advertisement revenue from content that it already was considered pretty much dead to begin with. So that is the future trajectory that I see Netflix going in. An advertisement powerhouse using its dominant share in streaming and its dominant ability to gather people's attention to deliver one of the most valuable, profitable, and compelling advertisements currently on the market. And as a disclaimer, I do own Netflix shares, and this is just my take on Netflix's earnings. Let me know what you all thought in the comments below. Do you have similar thoughts and expectations from Netflix? Or do you think I'm over-exaggerating the potential of their ad business? Please let me know in the comments below, and as always, if you like the content we make, please like, subscribe, and keep watching Interesting Investments.